Over 25% of the S&P 500's weighting is taken up by the 5 biggest companies in the index. This is because the S&P 500 is weighted by their size, also known as their market capitalization, meaning that if a company grows relative to the others, you will automatically invest more into that company and less into the others. But what's the issue? If these companies are continuing to grow and generate returns, isn't that a good thing for investors? Well, one of the key selling points of investing into index funds is diversification. But if a quarter of your money is tied up into 5 businesses, are you really diversified? It's like turning up to an all-you-can-eat barbecue and the only thing you put on your plate is chicken wings. Today, we're trying to answer a few questions. Is the S&P 500 still a well-diversified investment? Have we seen anything like this before, and what were the results? And what other options do investors have if they feel like they have too many chicken wings on their paper plate? As always, this isn't financial advice. Any specific funds we discuss are solely for the purpose of context and are not investment recommendations. All investments have risk and can decrease in value. Goldman Sachs warns that this level of market concentration hasn't been seen for decades and could potentially limit growth over the next 10 years. Morgan Stanley has also stated that this over-reliance on a handful of companies effectively reduces diversification and makes portfolios vulnerable to company-specific news. It's a bit like a big Jenga tower. The stability of the tower is almost solely relying on a few blocks at the bottom staying in place. If you were to pull just one of those blocks out, the entire tower could come crashing down. And this concern isn't baseless. If we look back at history, over-concentration in markets rarely ends well. The Nifty-Fifty craze in the early 1970s had brands like Polaroid, IBM and Coca-Cola dominating the scene, and it looked like they'd never slow down. Until they did. Despite maintaining steady growth and proving some of their skeptics wrong, they still drastically underperformed what was expected of them, leading to a period of next to no growth for the S&P 500 between 1973 and 1982 after inflation. Then we saw a more dramatic situation during the dot-com bubble in the year 2000, with major players in the market such as Cisco, Intel, and speculative icons like AOL all seeing their stock price plummet, and as a result, so did the S&P 500. Previous data isn't a reliable way to predict the future of the market, but it's interesting that in similar situations to the one we find ourselves in now, we've seen this result more than once. But that doesn't mean that it will happen every time. In fact, market analysts from the asset management company Alger have argued that the biggest companies we see today are fundamentally different from previous market leaders, as they have a hold over the global market, not just the US. At the time of recording, 16.5% of the FTSE All-World Index, a global index rather than just a US-focused one, is made up of these same 5 companies. These businesses have customers all over the world, not just in one country. But what could be concerning is that they all operate in the same market sector, technology, and no sector has ever consistently dominated the market throughout history. Naturally, with market cap weighted indexes, certain market sectors will always reign supreme. Different industries become more relevant or necessary, and the stock prices of the main companies within those industries will soar, thus meaning that these indexes will allocate a higher percentage of weighting to them. Right now, technology is the sector on top, with tech companies accounting for about 30 to 40% of the market. And it seems like this has been the story forever, but as recently as the early 90s, tech stocks only accounted for 6%. In the early 90s, major sectors like financials and industrials were thriving, and in the 80s, they were all outweighed by energy, which made up 29% of the market during a period of geopolitical tensions, supply issues, and a strong global demand as oil companies dominated the scene. What this suggests is that regardless of how much a sector grows and how much dominance they have over the rest of the market, they won't stay on top forever. So this potential overconcentration on a few tech companies could be worrying for some. We've already discussed how even global indexes seem to be over-reliant on these giant tech stocks, but if we remove them from the equation entirely, you'll see that this is far from just an S&P 500 problem. In fact, certain other countries can make the S&P 500 look like a model example of diversification. Take the UK's FTSE 100 for example. Even though this index tracks the 100 largest companies in the UK, only a few of these companies account for a large portion of the weighting. Shell, AstraZeneca, and HSBC currently take up over a fifth of the market on their own at the time of recording. And throughout history, the top 10 holdings of the FTSE 100 have made up nearly half of the entire indice's value. That's like going half squash and half water levels of concentration. Some other examples of this are in Switzerland, where their market is heavily reliant on companies like Nestlé, Roche, and Novartis, and even in a country the size of France, where you might assume they have a thriving index made up of multiple huge businesses, they have a massive amount of value tied up in Louis Vuitton, a bit like a modern day SoundCloud rapper. So while there could be an issue with how much of the S&P 500's value is in their top 5 holdings, raising over-concentration concerns, it's not like this isn't a common occurrence for market-weighted indexes across the globe. However, if you are worried that your supposedly diversified funds are tied up into too few companies, there are some options to increase your diversification. Here are 4 different options that you could consider. And remember, this isn't advice, nor is it an investment recommendation. These funds are shared only for example and educational purposes. Instead of concentrating your entire investment into just the American market, you could invest into thousands of companies based all across the world through indexes like the FTSE All World and the MSCI All Countries World Index. Going global still gives you a really large focus on the US market, but you're not only covering the US. Around 35% goes to countries around the world at the time of recording. For some other options, you could choose indexes that take a slightly different approach. Think of this like a work karaoke night. In a regular market cap weighted index, the same 4 or 5 people queue up to sing over and over again, usually the biggest and best singers, but you might want someone else to have a turn on the mic. One option here is the equal weight index. Equal weight indexes will divide the weighting up as evenly as possible. So if you have 100 businesses in the index, each of them would get 1%. In the S&P 500, everyone gets 0.2%. This allows everyone the chance to get up on stage and have a sing-song without it ever getting too repetitive. Some people who maybe wouldn't have wanted to sing if others were dominating the stage can now show off the pipes that they've been hiding. And it's the same with smaller companies in these indexes as well. And equal weight indexes have actually outperformed market cap weighted indexes over the long term so far. However, the main issue with equal weighted indexes is that you won't benefit nearly as much from a standout performer. If Deborah from HR turns out to actually be the next Celine Dion, you're only getting one tune out of her. And that's the same as if, say, Apple skyrocketed in value, you would still only have a small percentage of your investment held in their stock. And then you've got to listen to Bill from accounts, and he stinks. For some examples of equal weight versions of the S&P 500 index, you have Xtracker's S&P 500 equal weight scored and screened, Invesco S&P 500 equal weight, and iShares S&P 500 equal weight ETFs. Fundamentally weighted indexes, known as a smart beta approach, will dish out higher weightings to companies that perform tangibly well. So things like revenue, earnings, dividends, or assets they own will all be taken into account. If someone gets on the mic and brings the house down, they might get given a few more songs. It's about people that can actually deliver the goods, rather than just talking about how good they might be in the future. This takes away the speculation of it all. You're not investing into companies based on how much they're predicted to perform. You amend the weightings off of actual results, meaning you're less likely to be caught out if the bubble bursts and a business never hits the heights people expected of them. Taking this approach does mean that you could be missing out on a blockbuster performance from the loudmouth at the back who claims they should have had a record label, because if one of the companies that is predicted to grow exponentially actually does, you've missed out on a larger slice of that pie. If you like the idea of this approach and want to find an S&P 500 fund that is fundamentally weighted, you have the UBS MSCI USA Value and iShares MSCI USA Value ETFs. Or, if you wanted to take things global, you could also look at funds like the SPDR MSCI World Value ETF, which will provide the same weighting approach but on a global level. Finally, you have capped indexes, and these sort of do what they say on the tin. Every company has a cap on how big it can be. They'll let the eager singers have their time in the limelight, but with a maximum number of songs allowed. So a large company could still take up 5% of the index on their own, but they would never exceed that allocation. Every time the index is rebalanced, if a company has had too much stage time, they'll have their allocation trimmed back down to keep things in check. You essentially have the same pros and cons of a market-weighted index, but it can never be too over-concentrated due to the caps. However, you also won't benefit as much if the large companies perform well, so it all depends on how much risk you're willing to take. We're not saying that any of these options are better than the other, and we're not even saying that they're better than a market-weighted fund. But if you're tired of standing and watching the same 4 people scream at each other over the microphone, this might give you some other venues to consider. It's worth noting that these funds are more niche, which means they don't benefit from the economies of scale as the larger market-weighted funds, which typically makes them more expensive to manage and invest into. There is no denying that the S&P 500 currently has a massive exposure to a handful of tech giants. But is that really a bad thing? After all, these companies are where they are for a reason, but it does reduce the amount of diversification within the index. So let us know your thoughts. Is this level of concentration a ticking time bomb, or just the natural evolution of markets in a tech-driven world?